Linda, do you want to kick us off?
You betcha. So, hey, everyone, welcome to the Copperwind Financial First Quarter 2023 Zoominar. I'm Linda Ely, and I want to start us off with just one question. Who is brave enough to sit next to me at the spring training baseball games next month? Now, for those of you who don't know, I have the extraordinarily dubious track record of getting hit by foul balls, hence the question on seating. Fortunately, the party deck is open seating, so consider yourselves forewarned. And also fortunate, we still have some tickets available for both games. So it's not too late to join us for our annual client appreciation event at the ballpark. We have a few tickets left for the Diamondbacks on Saturday the 4th at Salt River Fields, and then plenty of seats, interestingly enough, for the Cubbies game on St. Patrick's Day, Friday, March 17th. If you want to join us, please reach out to us before or following today's call, and we'll be sure to get you on the attendance list. So let's get down to a little more serious business today. Joining me on today's Zoominar will be David Daughtry and Karina Olson. We've decided to let Eric and Jake take a break this time. Everyone has come in on mute, as you usually do, into the Zoominar. Our prepared remarks today should take us somewhere around 35 minutes. And then we'll follow that with our usual Q&A session. But we do welcome you to go ahead and pose your questions as we're going through our material. And you can do that if you hover your cursor over the bottom of the screen. There's a Q&A button at the bottom of the screen. Just type in your question there, and we'll be monitoring that. If we can't respond during the session, we'll try and get to you at the Q&A session following the prepared remarks. And if we still aren't able to get you in by that time, we'll follow up with you each individually. So speaking of baseball, we're making a change to some of our team lineup. As many of you are now aware, I have officially announced my retirement in May. You're all going to be in great hands, however. I just wanted to remind you of the team that we've built here to support you. At the center of the universe, obviously, is you, the client, followed by the advisory team, David, Eric, Jake, and Karina. And then we have our great paraplanners, Myra and Javi. A quick shout out to Javi, who passed his CFP exam in the last quarter of last year. That's an awesome achievement. That now means we have 6 CFPs on staff here. And then, of course, our superlative support staff in the front office, Kim, Amy, and LaShondra. You know, the firm has come a long way since David and I sat at his kitchen table back in 2005 and started Copperwind Financial. And what I want to assure you of today is the firm is going to continue to expand. And the reason for that is we want to ensure you have all the resources and expertise you and your family and your business will need to take you through your own retirement. So let's jump into the meat of the discussion today. Karina is going to start us off with the highlights and, unfortunately, some of the lowlights of 2022. And then David's going to follow up with his thoughts on the markets and the economy in 2023. I get to talk a little bit about the opportunities we are seeing for this year and then how that's impacted your portfolios thus far. Then we're going to bring it back to Karina to discuss some legislative and operational changes we want to make you aware of. So a lot of ground to cover. Karina, why don't you get us started with a little walk down memory lane on 2022, the year that was.
Thank you, Linda. I appreciate it. So looking at the screen here, this is our timeline of last year. And that gray line that goes across the screen with all of those ups and downs, that's the S&P. And you can see that lots of ups and downs and bear market rallies. I think there ended up being a total of 8 bear market rallies last year. So if we start at the very beginning, though, it started off with kind of a bang with Apple actually becoming the first company to hit over $3 trillion in market cap. Now, fast forward to beginning of this year, if you remember the headlines in the first trading week of January 2023, Apple actually fell below $2 trillion. So they lost $1 trillion in market cap over the course of the year. If that doesn't really sum up how last year felt, I don't know what else would. I was reminded today, though, that Apple is on their way back up over $2 trillion now. But looking at some of the headlines that really impacted the market and the economy last year is starting in February, Russia invaded Ukraine, and that was felt across the globe on so many levels. And then we were also experiencing inflation across the globe as well, but specifically here in the US, inflation hit its highest in 40 years around midsummer timeframe at 9.1%. And then with that, we were already starting to see the Fed really try to increase rates to combat inflation. They started that in March, but we really didn't see the impacts of it because inflation just kept on rising. Things like eggs, which is still the talk of the town, and gas and some other things as well. As the Fed was raising rates, though, that did impact a couple areas. One of them was mortgage rates. So we did see mortgage rates actually top over 7% in the fall. And with that, that did start to cool off the housing market a little bit. So 2020, 2021, we saw the housing market prices really increase and they started to come down. The other thing that was severely impacted by the Fed raising rates is the bond market. So we actually experienced the worst bond market of all of our lifetimes this past year. It was down 13%, the bond aggregate, and that's the worst we've seen. I know Linda's going to get a little bit more into that later on. So if we go to the next slide, this is actually talking a little bit about inflation some more. So again, the talk of the town last year. And if we go back in time to a pre-pandemic world in April of 2019, Bloomberg came out and asked the question, is inflation dead? They thought we had it under control. Fast forward, pandemic happens, post-pandemic, November 2021, Bloomberg comes out and says it's back, inflation. And Linda, how long has Copperwind been talking about inflation?
Sorry about that. Well, we actually started, I think, our Q2 Zoominar, we started mentioning the fact that inflation was probably going to be a little more persistent than the Federal Reserve was forecasting. And it turns out we were right.
Yeah, they kept throwing around that word transitory. And inflation turned out not to be transitory. And so it came in much hotter than expected all of last year. And that really weighed on the stock market, especially on the growth stocks. So on the next slide, we're able to see that with the 2022 performance of asset classes. And you can see, and you heard us say this so many times last year, there really was no safe place to hide. So in equities, the S&P was down a little over 18%. And then those growth stocks, the NASDAQ down over 32%. Already mentioned it, but the bond aggregate, the index we follow there, was down 13%. So looking at this, lots of red on the screen. The only green we did see was in some areas in commodities, mainly oil and agriculture. And so inflation quickly took its toll on the market, on the economy. The Fed realized again that it was not in fact transitory and that they needed to do something. So they quickly started to raise rates. So what you're seeing here on the screen is the chart of how fast the Fed raised rates during these different time periods. And 2022 is that sharp line going straight up there. And what we ended up seeing was the Fed raised rates 7 times last year. 4 of them were actually 75 basis points. We hadn't seen a 75 basis point increase since 1994. And hard to really think back all the way to January when the Fed was still keeping the rate at 0. And now we ended the year at this 4.25% to 4.5%. So a very dramatic increase over a very short amount of time. Now, unfortunately, with the Fed raising rates, this isn't the last you're going to hear of it. And so this is still a hot topic for this year, something we're still talking about. So I'm actually going to pass it over to David now, who's going to go ahead, share a little bit more of what we're watching for 2023.
Thanks, Karina. I'll talk a little bit about our outlook and what things that we think are going to be positive, things that we think are going to be negative. But a lot of the same things that Karina was talking about, inflation and the Fed raising rates, is going to be the hot spot and the hot topic for all the next year. And this is just a chart of looking at Fed funds. And to begin, Fed funds, everybody talks about it. All it is the rate at which banks lend money overnight to each other. And that's the way the Fed raises or lowers rates, with the short-term rates there. And this is a graph that shows what the market thought the Fed funds rate, what it will be each time the Fed Open Market Committee meets. They're the ones that set the rates in 2023. What you will see is the market thinks that it's going to peak at a little bit less than 5%. And right now it's 4.5 to 4.75. And that by the end of the year, they're going to drop the rate to less than 4.5. That is not what the FOMC and the Fed, what they have been saying. In fact, Neil Kashkari, who's the Fed president in Minneapolis, just in the last week said he thought the highest rate should be at least 5.5. And several others have said it's going to have to go higher than they thought before and probably stay higher longer. So I think the market is getting this wrong, and that could be a negative to the market going forward, because if they think it's coming down and it stays higher, it will probably hurt both the bond and the equity markets. So that's what we're seeing of the expectations. But if you look, the Fed is trying to slow things down, and so that they're trying to reduce GDP. They don't say they're trying to put us into recession, but the reality is that's exactly what they're trying to do. Not a deep recession, but when they talk about soft landing, the reality is they've never been able to manage that, and we will probably be in a recession. 6 months ago, we would have said by the second quarter of this year, we're probably there. But the economy has been a lot more resilient than people thought. And, the last 2 quarters, you've had, nearly 3 or above 3% GDP growth, which the Fed wants that to less than 1 and probably slightly negative. So why is that not occurring? Well, a lot of it has to do with the consumer spending. And if you look at consumer spending, this is real final sales of goods. But, it was going along quite nicely before the pandemic, then it plunged. And then the rebound in 2021 was quite spectacular as everybody opened up and bought everything they could. And then it slowed down a little bit in early 2022. But what you're seeing is it is an all-time high. And the numbers this week actually were better than expected, which is worse for the market and for the Fed as far as them wanting to slow things down. Year over year, spending by consumers was up 6.4%. And all 13 sectors or categories in that were positive. So if they're trying to slow things down, they haven't gotten them to slow down yet, which means they're going to continue to raise rates. And they're really trying to slow things down to stop inflation. The problem is the numbers that we got this week on inflation at 6.35% year over year. Yes, as Karina talked about, inflation, peaking in the summer, it's come down from there, but 6.35% is a far cry from the 2% target that the Fed has. Now, where is that hurting the most as inflation comes up? It's really on the most vulnerable segments of our economy. So this table or chart on the left-hand side is looking at people that make more than $100,000 a year. On the right-hand side, it's those that make less than $50,000. And the chart is just showing the increase from the first of last year of how much people spend in excess of what they make. And what you see is, and that usually goes into credit card balances that you see going up. And what you see of those making 100,000 or more, that increased by 1.7%. Small increase, rounding error. But when you look at those making less than 50,000, it was 7.2% increase. And, we've seen that time and time again. If we go into, recession or inflation, other things that hurt, the economy, usually those in the lower economic deciles, they get hurt the worst. And that's what we're seeing here. Now, when we look at are we going to go into recession? This is where you see a lot of indicators that say yes. And this is a composite by the Conference Board of the leading economic indicators. And the way to read this chart is the blue is negative. Now, I lost the color wars debate here. I wanted it red, but they overrode me. So the blue is negative, the green is positive. And along this chart, going back to 1970, the gray areas are when there's a recession. So most of the time we're not in a recession, but what you see is every time we're in a recession, it's preceded by the blue, which means a decline in the leading economic indicators. And what you see right now at the very end of the right-hand side of the chart is we've got 9 months of consecutive declines in the economic indicator, leading economic indicators. So that if history is any guide, that says we're going to have a recession. It doesn't say how bad it's going to be, but it says we're going to have a recession. Another thing, economic indicator that a lot of people look at is the yield curve inversion. And all that means is that longer term rates are lower than the short term rates. And normally it's short term rates are lower than long term rates. If I'm going to lend you money for 2 years, I'll do it at less than if I'm going to lend you money for 10 years. That is not true today. Right now, the 2-year is about 4.5%. The 10-year is about 3.7%. And that, when you look on the purple down below, it's sort of the same thing. That goes back to 1980, and the circles are where we had inversions. And the grayed out areas show where we had recessions. And nearly every time when you had a yield curve inversion, after that, you had a recession. Doesn't say how bad they're going to be, but it nearly always indicates a recession. So those people that are looking and saying, are we going to have a recession? They've got a lot of ammunition, because historically, that's exactly what happens. Now, why is inflation staying, such a tough, situation? Why is it sticky? Well, it's not on the good side. In other words, things that we make, the inflation has topped out last year and is actually in pretty good shape. The problem is wages. And when you look at the service sector, what you see is pre-pandemic, you can go back 10 years, and it was about 2 to 3%. That's where it's been. During the pandemic, it was all over the place, from jumping up to jumping down. But over the last year to 18 months, we're at about 5%. And that's substantially higher than the 2% inflation we're talking about. And that's not going to go away quickly. If like Karina talked about eggs. Well, if I get more chickens next year and we have more eggs, the prices are going to go down. But it's very hard to reduce prices on wages. You give somebody a raise, you're not going to take it away next year. So that tends to be sticky. And why is it not going down? Well, the problem is we can't raise chickens on the labor side. There's not enough new workers coming in. So if we look at the strong labor market, and this is the latest unemployment numbers at 3.4%. The last time we were at 3.4%, it was basically in 1969. I was in 4th grade. I've got a lot of gray hairs now. It was a long time ago. And what you're seeing is it's not going to go away. Like I said, we can raise more chickens and have more eggs, but we're having more people that are retiring and not enough new workers in the workforce. And that has led to a lot of job openings that are not being filled. So, but this is a chart that shows the bluish green, that's job openings. The brown or the tan is unemployed persons. And if you go back for most of the history of this, this data point set, what you see is there's nearly always fewer job openings than people unemployed. Today, that's completely reversed. We've got 11 million job openings and only about 5.7 million unemployed. And you're saying, yeah, but David, I have seen lots of companies announcing that they're having layoffs. I will tell you the sort of the dirty little secret. Companies announce stuff that will help their stock. And in this first quarter, nearly every company that has announced layoffs, the next day, their stock goes up. So if I'm CFO, what do? We're going to lay off some people. One of my nephews that works for Facebook, when they announced layoffs in January, I called him. He goes, oh yeah, there's layoffs. He said, but a lot of those people are interviewing for jobs in other divisions where we've got job openings. So yes, there will be some real job layoffs, but the majority of this is really smoke and mirrors, and it's to help somebody's stock price. You're still seeing very low unemployment, and I think that's going to continue. Now, one of the things that we're also seeing is earnings growth declining. And what you can see here, the blue line is the earnings for the S&P 500, and the green is the S&P 500 index. What you see is that blue line recovered dramatically right after the pandemic start, And it did well up until really the last 6 to 12 months. And then it's starting to go down a little bit. And what you're seeing is last year when companies were saying, oh, our costs are going up both on the labor side and on the material side, they nearly always were saying, and we're able to push those costs to our customers. Therefore, our profit margins are either increasing or at least staying stable. You're not seeing that this first quarter. Now, is it CFOs that are trying to lowball the numbers? Maybe, but if you look at full year, and that the blue line is really the 12-month rolling average. But if you look at for last summer, what they expected the earnings to be for all of 2023, it was 250, and now it's down to about 223. So you're looking at a significant decline, whether, like I said, is that lowballing by CFOs to say, oh, we beat the numbers, or if it's real, we don't know yet. Time will tell. But we did find a cute little thing here with the Simpsons of Bart saying, oh, profits are down 10.3%. And Homer, always the realist and sometimes the pessimist, says profits are down 10.3% so far, indicating they could go a lot lower. And so we could end up with an earnings recession, even though we may not go into a recession. I will tell you, our base case scenario, though, is that we will probably within the next 12 months go into a recession, and that it will probably be very shallow, simply because when we've got start from 3.4% unemployment, it's probably not going to be a deep recession. Now, there are some outlier things that we can't control and could come out of the blue. One of them is the war in Ukraine. If they were to come to a ceasefire on that, the market could rally dramatically, because that uncertainty is a big thing. Or if Putin, heaven forbid, were to drop a nuclear weapon in Ukraine, market would probably drop 20% overnight. There are all of these black swan events occurring. They always do, whether it be a pandemic. If we were talking in 2019 and I said, we're going to shut down everything and everybody's going to work from home, you guys would say, he's on something. He must have been, smoking dope or something. And those things occur. People said a year ago, oh, they're not going to really invade Ukraine. That'd be crazy. Well, now we have it. So there's always some of those, but we just have to go with what we see and adjust accordingly. So we're not super pessimistic, but we do think there's probably a slight recession. But I think there's some opportunities, and I'll turn that over for Linda to talk about the opportunities we see.
Okay, thanks, David. Well, as he mentioned, there are obviously a lot of economic speed bumps to watch out for this year. But while challenges persist, we do think there are some potential opportunities in 2023 that arose because of what we saw in 2022. So here's an investment trivia question for you. When was the last time the international markets outperformed the S&P 500 for a full calendar year? Would you believe 2017? So some 6 years ago. And prior to that, it was 2012. So the reality is only 1 year out of the last decade did we see international markets outperform US markets. Could that trend finally change for 2023? Possibly. So both emerging markets and developed international markets have actually trended better than the S&P over the last 3 months. Now, one of the current drivers behind that has probably been the weakening dollar. Last year, with the Federal Reserve aggressively hiking interest rates, the dollar experienced almost record gains against international currencies. That's what the world does for your currency when you start to practice good fiscal policy. So dollar strengthened, that actually hampered returns for international markets and commodities. Now, with the shift this year, the Federal Reserve in December began to move from 75 basis point increases, as Karina talked about earlier, down to 50, now most recently 25 basis point increase. They're slowing their roll, if you will. And this is allowing the dollar to weaken versus other currencies and providing a real nice tailwind to some of the international markets. Now, emerging markets have also broken out because the Chinese government finally decided to relax their COVID restrictions. So investors are leaning more into the potential for a recovery in the Chinese economy, similar to what we enjoyed once our economy finally reopened for business following the pandemic. The question of whether we see a year-end result ahead of the S&P 500 for international stocks It's going to be up to the Federal Reserve again. If we see inflation subside and the unemployment rate, start to climb, that will give the Feds the space to be able to slow the pace of interest rate increases or even potentially pause. Continued strong employment and a resurgence of price inflation, though, the Feds then ruin the international party and we're back to volatility. So for now, as our models are trend following and the trend has been positive, we have added a small measure of international exposure into several of our portfolios, as well as in our 401k allocation. Now, can we talk about just how bad the bond market was last year? The bond index, known as the AG, it wasn't just bad. It was the worst finish to a bond market in history by a factor of 4x. To Karina's earlier point, this really left us with very few safe places to hide. Now, I wish to point out that this was not the bond market that everyone got. There was better sailing if you had the right captain of your ship. Here's our ship. And total return was that for you last year. With the bond index down 13%, we saw returns on our active bond strategy, depending on the flavor that we had you in, down far less than this. Here's how it looked on a relative basis. So this represents 5 years worth of data. And what you're looking at along the y-axis, we're showing returns for the last 5 years, and the x-axis shows risk as measured by standard deviation. In the middle of our chart is the bond index marked the AG. To the right are ETF symbols of the various types of bonds that we like to use in total return. So junk bonds, high yield municipal bonds, preferred stocks, etc. And last year, over the last 5 years, what you will see is pursuing this active strategy of selling and buying served you very well by protecting your portfolio from double-digit losses in bonds. And you will see total return in the top left-hand corner of our graphic here, representing higher returns and less risk than any of the bonds represented here. That's what active management can do for your portfolio. So let's look more specifically at high yield bonds. This happens to be just over the 3 years of the pandemic, but I do want to point out that while we're using this time period, we could show you every trade for the last 13 years since we began trading this model, and you'd see very similar behavior. All the red arrows indicate where we sold out of our high yield bond position. Green arrows show where we bought in. And as you can see, we didn't get out at the top and we didn't get in at the bottom. And in fact, there were a couple of occasions when we had a little whipsaw where we bought in and then quickly had to sell back out. The important thing I wish to point out are the times where we sold out, that the bond market then experienced sizable drops, or that we were in and able to stay invested and gather those dividends and get some capital appreciation. Now, since bonds did drop by so much last year and the Federal Reserve has begun to taper back their increases in interest rates, we think this will allow the bond markets to stabilize. And we have great potential in these very bonds to have an above average year. One of my favorites this year is senior secured bank loans. Now, those are loans that banks make to corporations that are secured by the assets of the company. So their plants, their equipment, their patents. As such, because they're secured, they tend to be pretty low volatility. And more important in the environment we're in right now, because they're floating rate loans, the interest that the banks charge to the companies can rise when the short-term lending rate rises. And that's exactly what's been happening over the last year. Today, the yield on those funds that we're using is over 7%. And we haven't seen yields this high since 2009. So healthy income, potential for capital appreciation have us actually very excited about the potential in bonds this year, provided the Feds can stay the course on interest rates. Again, inflation surprises or persistently low unemployment could send us right back to cash or short-term treasuries. The good news is those things are now paying better than they were a year ago. So bottom line, we see the best risk reward for 2023 in our bond strategies. In fact, in your bond portfolio here, we lived mostly in short-term T-bills last year. Our models began to move this into floating rate and high yield in November. Today, we're fully invested in those asset classes along with some preferred stocks. And the yield on your income portfolio right now, 7.4%. So international markets, certain commodities, also bonds, all show good potential if we finally have turned the corner with the Feds. We will be watching, and then now you go to the next slide, the inflation, the labor markets, interest rates, of course, and all the economic data. And the best way to summarize this chart for you is this way. In 2023, good news is bad and bad news is good. That means if the unemployment numbers start to tick up and inflation ticks down, that's actually good. If we see earnings start to weaken, that's actually good. Whereas if we see employment start to continue to be tight and improve, inflation numbers continue to move higher, that ultimately will not be good because it'll force the Fed's hand on continuing to raise rates. And we might get some shocks if they're too aggressive about doing that. So echoing David's assessment, we're cautious on the outlook for 2023. We expect continued volatility as the economy continues this post-pandemic adjustment. But I'd say more optimistic that as this story plays out, we'll find some good opportunities here. Now, Karina, let's look at some of the legislative changes that took place right at the end of 2022 that could also mean some interesting planning opportunities for everyone.
Yeah, thank you, Linda. So looking at what happened towards the end of 2022, Secure 2.0 got passed right before the end of the year. And this does bring about some changes that impacts a significant amount of you and of our clients altogether. The biggest one is RMD age. So if you guys remember back in, I think it was 2020, they changed the RMD age from 70 and a half to 72. Just changed again. So starting this year, it's now 73. And then over the next 10 years, it's going to work its way up to 75. So what's interesting, I was just talking with Linda about this the other day, is no one has to start their RMD for the very first time this year, because last year, if you were 71 about to turn 72, you would have had to take it this year. But now it's next year for 73. If you have questions about that, when you need to take it, how it's calculated, all of that, please just reach out to us. We'll be happy to walk you through it. Some of the other big wins that came out of this too is you no longer have to take RMDs from Roth 401ks or 403bs, and the penalty for missing an RMD is going to decrease as well. There's some other things in there you can see on the screen here. And just to kind of sum it all up, it all has to do with ultimately Secure 2.0 is trying to increase retirement savings, make it easier for the investor to access retirement savings in case of an emergency, and then also help the employer out too to make it easier to fund and establish these different types of retirement savings. With a lot of these, there's still some kind of muddy waters, not very clear on exactly how we go about doing it, specifically this 529 one. So using 529 funds to fund a Roth IRA. We're expecting more guidance to come out over the course of the year. So as we learn more, we'll definitely pass that along and share it with everyone. In the meantime, if you think one of these applies to you, you want more information on it, just give us a call. We'll be happy to walk you through it and talk about how it impacts you. Something else that's going to impact a lot of us this year is actually going to be more on the operational side, and that is the Schwab TD integration. So back in 2020, Schwab bought TD Ameritrade. Thankfully, they've been taking their time with this integration, and we haven't seen the two platforms completely merge yet. But we do finally have a date for this. So over Labor Day weekend, if you still have a TD account, that's going to go ahead and move over to Schwab for our CopperWin clients. Some of you may already be on the Schwab platform completely. Some of you may be still just TD, or you might have a combination of the two. So the big thing we're asking though is if you're still with TD, have TD accounts, we want to make sure that you're able to log on to advisorclient.com, have your username, your password set up, because after this merge happens, you'll be able to use that exact same username password to access the Schwab account. We're told it's going to be that smooth that you'll just be able to log on, same username, password. We do expect a couple bumps in the road, but we will definitely be monitoring it, here to answer any questions. As we learn more information over the course of the summer, we'll make sure to pass that along. We hope the same from you guys. If you're starting to get any emails, letters, or anything like that, you have questions about it, give us a call, and that way we can help walk through it. So just something we're keeping an eye out for this year. But with that actually sums up the presentation part of this. So we're going to go ahead and move on over to the Q&A. So we did have a handful of questions come through. So I'm going to go ahead and start off with this. The first one, David, it looks like this is from your section when you were talking about the economic indicators. How long does the economic indicator decline typically last before that recession hits?
It all depends. I mean, when you look at it in the pandemic, I mean, it didn't last very long before we were absolutely in a recession, simply because it was a hard stop on the economy. I think it's probably longer this time. We've got 9 months of it, and some of the time you're in a recession when that first starts. I mean, only a few months. Now we're 9 months into it. And people say, well, it feels like we're in a recession. The data doesn't indicate that. I mean, you don't have 6.5% spending increase year over year and you're in a recession. So I think it may be because we're starting from such a good economic position, low unemployment, corporate profits really high, that it may take another 6 to 12 months. I mean, like I said, 6 months ago, I would have told you, I think by the first or second quarter of 2023, we had been in a recession. Here we are halfway through the first quarter, and I would look and say, I think it's the third or fourth quarter. So I think it's going to be longer. And there may be some times that it jumps up, for a month or two and then, pushes back down. But the Fed is going to have to continue to raise rates and keep them restrictive to slow things down to get inflation under control.
So, David, that's helpful there with the economic indicators, but what about the yield curve? How long should we expect that to stay inverted?
I think once we get to where they say, here's our, we're waiting to see what happens, which is probably 5, 5.25, 5.5, where they'll be probably by this summer, late spring, early summer. And at that juncture, if they've reached the level that's slowing things down, you'll start to see that either longer term rates coming up to that, or more likely sometime next year, the Fed starting to lower the rates, because at 5.5%, that's not the neutral rate of we're no longer, hurting the economy or, or stimulating it or slowing it down. That neutral rate, and there's a lot of research done on the neutral rate. At one point, they said it's nearly zero. Well, it's clearly not nearly zero now. And so they'll probably say, okay, it's not 5.5, but we've got inflation under control. And then they'll bring it down to 4.5 or 4 or 3.5. And then you'll see probably that we go back to a regular upward sloping yield curve, not an inversion, but it could take a while here.
So talking about what the Fed's doing too, the balance sheet is the other part of this, right? So they're raising rates, also trying to decrease the balance sheet. And we've talked about before, as inflation goes up, that's going to help kind of solve that balance sheet problem. So do we feel like that's part of what's happening here with this continued rise in inflation?
Well, when they first announced, and it was over a year ago, that they were going to start reducing the balance sheet, and they said it would start out at $47.5 billion reduction, and then in the September 1st, it would go to $95 billion. They said it like that's what's going to happen. And then we got to when it should be going down $47.5 billion, and it wasn't. And then they sort of pivoted and they said, oh, you guys misunderstood. That's a target, but that's the upward target of the maximum we would do. So I think they were sort of afraid of what would happen if they did that. They are reducing it. They're still not reducing it $95 billion at most months. And I think that is what caused really the mortgage rate to go from 2.5 or 3 all the way up to 7, and now it's come back down to the 5 or 6% range. But the balance sheet reduction, them not buying more bonds and letting bonds mature and taking that money out of the system, that is what's keeping longer term rates higher than they would have been. And I think that's really an experiment, because they've never really done that in this large of a manner, and they don't really know what it's going to do. So I think that's once they stop raising rates, if they continue to let the balance sheet decline and effectively suck out $95 billion every month out of the financial system, I think they'll have to see, because that effectively is a reduction in liquidity in that we've benefited for a decade of them doing that. And now, it's going to be the opposite. And so I think they don't really know what that's going to do, and they'll probably take it slow. But at the level that they're going here to get back to pre-pandemic, I mean, you're talking about, 3-4 years at the least to get back to that level. And they're not doing the full 95 billion a month. So we'll see. It's an interesting experiment they're doing.
Interesting is a good word for it. So staying on the Fed rates topic, but switching it, and Linda, I'm going to ask you this one since you're our kind of real estate guru here. But with rates staying higher longer, we're expecting them to continue to raise this year. How do you see that affecting the housing market? And of course, the question on everyone's mind, is it 2008 all over again?
Well, great question, especially given the fact that I have a house up for sale right now. So I'm living it firsthand. I think there's two answers to the question. And one is, we came out of a decade of sub 5% mortgages, right? I mean, Karina, your mortgage is less than 3%. We talked to somebody yesterday whose 30-year mortgage was 2.75. Mm-hmm. I think the impact of that is that no one's going to want to move out of their house with those low interest rates, right? So that affects inventory. And, it's just the good old supply and demand equation, where if you don't have enough supply and you have people needing a home, that could continue to push, at least stabilize prices, maybe not push them higher, but at least in this market, stabilize them in spite of higher mortgage rates. The other part of this equation comes out of the pandemic. And I will be curious to see how this unfolds over the course of the next year. During the pandemic, everybody took to Airbnb and VRBO like fish to water, right? It's, oh my gosh, I can have this vacation experience in all these different places. I can work remotely and I can do so in the luxury of a home, not a hotel. And that was a huge boon to investment real estate. I do believe that with a lot of legislative changes in communities now, that people are starting, and vacancy rates. And we've heard it from a couple of our own clients who've had investment properties where they only had them rented 1 or 2 weeks all of last year. As that ceases to become attractive, and as bond yields get higher, they're going to want to put their money to work in other ways where they can actually get a yield that they are not now getting out of their rental properties. I do think a lot of our inventory problem was soaked up, homes were soaked up by those investors. If those investors now dump real estate on the market, that could be very beneficial for the inventory levels. But I don't see a 2008. What we don't have here that we did have in 2008 is we don't have people who are in credit stress, right? So I think that we don't see a 2008, but I do see a return to a more normal real estate market where you don't have 50 people waiting outside, unfortunately for me, outside of your door to make an offer on your house, but things are staying on the market 1 or 2 or 3 months.
Yeah, I think, Linda, you're exactly correct there. And along with that, in 2008, all the banks got in trouble. So they sucked in, their credit lines and say, hey, we're not going to lend to hardly anybody, or the terms were really bad. We don't have that. I mean, the banks are in the best financial shape they've ever been, mainly because they were required to have more capital after 2008. So it's not the same as 2008 for sure.
And the other thing too, going off of that, David, right? So not the liar loans, people able to make their mortgage, and what you were talking about earlier, the employment rate. So as long as people are keeping their jobs, able to make their mortgage payments, then we're not going to see those foreclosures that happened in 2008.
Well, and when you look at economic stress, everybody says rates have gone up, and they have. If you're looking to buy a house, it's bad news. I mean, your mortgage payments will dramatically higher. But the vast majority of everybody that already has a home, they've got a fixed rate mortgage, and it may be at 2 or 3%. So if mortgage rates are 7, and I'm not selling my house, and I'm not trying to buy another house, it doesn't affect me at all. I've got 30 years of 2.5 or 3%. And so financially, I'm in great shape. But I think it goes to Linda's thing of, but I'm in great shape, but I'm not going to sell my house because I'll go from a 2.5 to a 5 or 6% mortgage. That doesn't make a lot of sense. So, but the vast majority of people refinance. In fact, I saw a data point a couple of weeks ago showing that like less than 2% of all mortgages outstanding does it make sense to refinance, because nearly all of them are way lower in yield. So,
that makes sense because you either bought it when it was lower or you refinanced while it was
Yep.
lower.
Yep.
Yeah. So changing topics, this is something we haven't hit on yet, but of course, big in the headlines right now, what a lot of people are watching is the debt ceiling. So what impact do you think that's going to have on the markets, both in the short term and the long term?
well, I mean, this is more of a political thing. We've seen it every few years for the last 20 years. And what we're seeing is they're not going to default on debt. With the last time we saw it in a really big way that caused havoc in the markets was in 2011, when the market actually, the market reacted dramatically in a negative way when S&P downgraded the debt of the U.S. from AAA to AA plus, and they haven't ever restored it to the AAA plus. But we're not going to default. We can print money if we want to and pay off the debts. Now that would be highly inflationary, and they're not going to do that. But it's really more, politics of let's play chicken here, which is stupid. But we've seen Republicans and Democrats do it for the last 20 years or 30 years, really. And that just pass the thing. We have to pay our bills. We're going to pay our bills. Just do it and move forward.
Yeah. So thanks, David, for that there. Kind of one last question here. I know we're at the 45-minute mark, so I want to be conscious of everyone's time today, but we did get a question still. I don't think we're seeing it as much in the headlines now, but still seeing it is about the student loan forgiveness. So a lot of the COVID relief officially comes to an end in May. Student loans is a big part of that. And so with student loan forgiveness, what do we think is going to happen with that? What do we expect to see come out of that?
Linda, you want to jump in on that?
I'll give my opinion. Then I think Karina, having actually spent a little bit of time in the financial aid offices, she can give her 2 cents worth. Maybe it's a nickel's worth now because of inflation. I think ultimately they get something done. I don't think it was the most eloquent way to address the issue. And if any of you are interested in my white paper on what do we do about student loans, I'm happy to share that with you. But I think that Biden ultimately will get something done. I think the timing on the announcement was more politics than practical, but I think ultimately we will see student loan forgiveness. Karina, you want to add to that?
Yeah, I think I agree. It's the same thing David was just talking about with the debt ceiling too, is I think this becomes a little bit more of a political issue, right? So announcing it before midterms, using it as a platform to stand on. But also, I mean, coming out saying it's going to happen, I think something will come out of that because it's a little hard to go back on your word now too, of kind of guaranteeing this and then it's, hurry up and go, wait, stop, take 10 steps back. And so I think something will come of it, but it's just going to take time, like everything. And it'll probably be drawn out a little bit from the political standpoint.
I did see a question of, are we investing in balloon futures? And the answer is we're looking for it, but we haven't found it yet. Because we don't even know if it's balloon futures yet.
Well, thank you, David, for answering that one. Linda, David, anything else we want to hit on before we let everyone go enjoy their Wednesday?
No, just a reminder that we still have tickets to the spring training games, and I hope to see you there, even if you don't sit next to me.
Yeah, I we've been doing this for 17, 18 years with Linda, and she does have, even one time we thought she was safe, and then as she left the ballpark and is driving away, a stray ball hits her car. So you bring a helmet if you're going to sit by Linda for very long, or be very vigilant because the ball's just like a magnet.
I think
she ought to go out and play. I mean, she'd probably just stand out there and just be able to catch it. She could have a basket.
I think I heard Javi say he was going to bring his mitt though and stand next to you, catch foul balls.
Yeah, she's got personal defender there.
Yeah. So spring training, please join us for that. The other thing is, as soon as we end this webinar, you're going to get a survey. Please fill that out. Let us know what you like, don't like, what you want to see more of from us.
And as always, we will have this posted to the website and we will send you a reminder. So if you want a copy of today's slide deck, we're happy to provide that to you. And thank you so much again for your time today.
Yeah, thank you
Yeah.
everyone for joining. Enjoy your Wednesday, and we look forward to seeing you in March for spring training.
Yep. Thank you. Bye-bye.